Before I place a stock on my watch list, I like to look at 4 different things. If you have a few minutes today, let me walk you through what those 4 things are, and maybe you'll find them useful like I do, and incorporate them into your research as well. I'll use Broadridge Financial, ticker symbol BR, as an example. This is a dividend stock I recently covered in my newsletter, Quality at a Fair Price, where I share a lot of my research. I'll leave a link in the description below if you'd like to check out some of the other content from the newsletter. Broadridge Financial provides investor communications and technology solutions for the financial industry. I know that doesn't tell you much about what Broadridge actually does. To get a bit more granular, Broadridge provides things like proxy and regulatory reports, class action material, and information on corporate events, things that all publicly traded companies have to provide to their shareholders quite frequently. Something that people may not know about Broadridge is that this company is a spin-off from Automatic Data Processing, better known simply as ADP. Since it was spun off, Broadridge has carved out quite a niche business for itself. Alright, let's talk about the first thing I look for in a stock before I place it on my watch list. I like to invest in winners, and a good method of finding winners is to find stocks that are already winners. What I mean is to take a look at the long-term track record of a company and see if it has a winning record relative to the broad market. More often than not, companies that are already winners continue to be winners in the future. Since inception, Broadridge has grown by nearly 1,400%, which translates to an annualized growth rate of 16.6%. That is an impressive feat, and a rate of growth superior to the average rate at which the overall stock market has grown. And it tells me that Broadridge clearly has a winning track record. The second thing I look for is a strong history of dividend growth and a reasonable payout ratio. Broadridge has a very strong 3-year dividend growth rate of 11.64%. The 5-year growth rate is just as impressive at 10.53%, and the 10-year growth rate is even better at 14.31%. What this tells me is that while the dividend growth has slowed a bit during the past decade, since the 3 and 5-year growth rates are lower than the long-term 10-year growth rate, all 3 of these growth rates are above average, which means that Broadridge is an excellent dividend stock. While Broadridge has increased its dividend at a very healthy pace, its payout ratio has crept higher over the years, climbing from the mid-40% range a decade ago to the mid-50% range today. This is still a relatively low payout ratio, with plenty of room for the dividend growth story to continue at a healthy pace in the years to come. The third thing I look for is whether a given company is actually a high-quality business. Quantifying the quality of a company is very subjective, but here's my simple approach. I look for 3 things that tell me a company may be of high quality. Those things are a growing revenue stream, a steady gross profit margin, and a healthy return on invested capital. Broadridge has grown its revenue year over year during the past decade at a pace of 10.51%. In my opinion, that is very good. The gross profit margin has oscillated a bit between 25 and 30%, but for the most part it's been rather stable. Since fiscal 2017, on average, the gross profit margin has improved, which is a very good sign. The return on invested capital is where I have some reservations with Broadridge. Between 2015 and 2019, Broadridge had a pretty strong ROIC, close to 20%, which was great. But between 2020 and 2022, these returns slid all the way down to 8.3%. In my opinion, that is not a very attractive ROIC. The upside is that since 2022, Broadridge has seen its ROIC improve, climbing up to 10.8% by fiscal 2024. The uptrend is a good sign, but a 10.8 return on invested capital is a little lower than I personally aim for. Overall, I think Broadridge is a quality business due to its strong and consistent revenue growth and a steady profit margin. The return on invested capital could be better, and it's certainly something to keep an eye on going forward. The fourth and final thing I look for is whether a given company is attractively valued today, and if it can generate an acceptable rate of return in the future. To measure the valuation of a stock, I like to use my custom free cash flow valuation tool that analyzes the historical free cash flow for a company and spits out a few valuation zones for me to consider. When I analyzed Broadridge earlier in the month, this tool showed me that the stock appeared to be about 15% undervalued, and it had an excellent expected rate of return of a little more than 16% per year. Today, the share price has climbed a little bit higher, but Broadridge still looks undervalued and still has an expected rate of return of 16%. Both the valuation and expected rate of return appear to be very attractive, in my opinion. The valuation is based on the free cash flow Broadridge generates today and a fair multiple we should pay for that cash flow. This is based on the historical trend of free cash flow growth, and a reasonable multiple that we should have paid for that cash flow in the past. The valuation assumes that future free cash flow will grow at relatively the same pace, and over time, the share price will trade at long-term historical multiples. The expected rate of return is based on 3 different inputs. The first is the forward dividend yield. At the time I ran my initial analysis, the forward dividend yield was 1.69%. As I'm recording this, it's 1.66%. The second input is the return to fair value component. If we assume that Broadridge is in fact 15% undervalued today, then over time we would expect to capture this 15% upside. In my expected return calculation, I assume this will happen slowly over a period of 5 years. So in this example, Broadridge earns a 2.83% annualized return boost from its potential undervaluation. And the third input is the 3 to 5 year analyst earnings growth forecast, which currently stands at 11.8% for Broadridge. Adding all 3 of these inputs together, I arrive at my 16.32% expected rate of return. This was the expected rate of return at the time of my analysis. Today, as I'm recording this, the expected rate of return is 16.12%, since the share price has moved higher, in turn lowering the forward dividend yield and the return to fair value component. It's a marginal change, and in the end, this is just an estimate. I'm not actually expecting this figure to be precise. What I look for is stocks that can offer a 10% or better rate of return going forward. To me, that is enticing enough to warrant an investment. That's it. These are the 4 things I look at to perform my initial review of any given stock. If a stock ranks well across the board, I'll add it to my watch list. Recently, I put together a high-quality dividend stock investable universe made up of 50 different companies that all ranked very well in this simple screening process. I share this investable universe with my Patreon community, in the newsletter, and on Seeking Alpha. Members of the community get access to live valuation ratings, 3 model portfolios based on this universe, and a copy of this custom valuation tool in Google Sheets. The valuation tool currently has 202 dividend stocks that can be analyzed, and each month I'm adding a few more stocks to this list. There's a link to everything in the description below. I'll be covering a new stock in my newsletter, Quality at a Fair Price, each Thursday. If you'd like to receive this analysis straight in your inbox, make sure to subscribe. I hope you found this review insightful. Enjoy the rest of your day.